Welcome to vTalkInsight, Market Drivers Daily for February 12, 2026. AI capital spending is colliding with a repricing of interest rate cuts, creating bigger winners and losers across equities, credit, and real assets. Let us start with how the AI build-out is reshaping sector leadership and valuation risk. AI has shifted from a broad growth narrative to a sharper differentiation phase, where entire business models are being re-rated in real time. Earlier in the week, the focus was on record capital expenditure plans still being warmly funded in credit markets. Today, that picture is evolving into a clear split, with the infrastructure side of AI enjoying strong demand, while software, wealth management, and advertising names endure another round of volatility and valuation pressure. On the infrastructure side, the evidence remains striking. Siemens Energy reported record gas turbine orders, nearly €18 billion, with around a quarter of its turbine backlog now tied to data center demand from the AI boom. That dovetails with reports of surging demand for utility-scale solar and battery storage to meet nationwide load growth, especially from data centers, and with Micron confirming high-volume production of advanced memory chips after a strong year-to-date share price move. Cloudflare is also outperforming on robust earnings, in contrast to weakness across many European AI-related stocks, underlining how markets currently favor the so-called picks and shovels enablers of AI over more crowded hyperscaler exposures. By contrast, disruption fears are hitting valuations across software and financial services. Wealth management names in the United States and Europe, including firms such as Charles Schwab, Raymond James, and LPL Financial, have seen sharp sell-offs as AI-driven tax and planning tools raise questions about long-term pricing power. Alternative asset managers have also sold off, despite limited direct software exposure, as investors worry about indirect risks across general partner stakes and other assets vulnerable to AI disintermediation. Horizontal software providers serving small and mid-sized businesses look especially exposed because cost-sensitive clients may favor cheaper, tailored AI solutions, leaving firms without strong moats or customer stickiness vulnerable to aggressive deratings on even minor disappointments. Set against that, a growing counter-narrative argues AI will augment, rather than crush, many incumbents. Charles Schwab, for example, expects AI to expand the wealth management market by allowing advisors to serve more clients, not by eliminating advice altogether, and points to robo-advisory history as a precedent for technology-driven industry growth. One major wealth manager reports cutting its inflation-adjusted cost to serve accounts by about 40% over 5 years through AI and technology investment, while keeping headcount stable and gaining market share. Enterprise software is also seen as essential to AI adoption because these platforms organize and optimize corporate data, and some analysts view the recent broad software sell-off as overdone, with companies like ServiceNow, Salesforce, and Apple, via its Apple Intelligence push, cited as potential long-term beneficiaries. Overall, AI-driven disruption is intensifying sector rotation and volatility, but the market is no longer treating AI as a monolithic trade. Infrastructure and energy supply chains, from semiconductors to gas turbines and renewables, are still being rewarded, while segments such as wealth management, alternative asset management, real estate services, and traditional advertising are being forced to prove their resilience. Key watch points now are guidance from software and financial firms on AI monetization, the pace of capital raising by large platforms after moves like Alphabet's heavily subscribed bond issuance, and any signs that regulation in wealth management and advertising slows the adoption curve. This bifurcated AI landscape feeds directly into the macro data, where jobs and output are surprising on the upside. The latest U.S. data point to a renewed burst of cyclical momentum, even as the expansion stays capital-intensive and relatively job-light. January non-farm payrolls came in around 130,000, roughly double consensus expectations, with notable gains in manufacturing and a lower unemployment rate. Private sector payrolls rose by about 170,000, and recent months have seen real goods output grow at more than 9% annualized, while manufacturing overtime and temporary employment have increased for 3 straight months, signaling firming industrial demand. On the demand side, the consumer backdrop remains more resilient than headline retail sales sometimes suggest. Bank of America's internal data showed January card spending up 2.6% year-on-year, the fastest pace in nearly 2 years, and overall consumption in the fourth quarter is estimated to have grown around 2.3% despite monthly noise. Company reports reinforce that message. McDonald's just delivered its fastest U.S. sales growth in over 2 years on value-focused offerings. Nike's running business grew 20%, helped by the Pegasus relaunch, and Robinhood's retirement assets under custody have more than doubled year-on-year to above $26.5 billion. Globally, growth is broadening with clear pockets of strength. Emerging markets, such as Vietnam, India, Ethiopia, and Latin America, are driving beverage consumption growth, prompting Heineken to tilt capital allocation toward these regions, while in developed markets premiumization and low or no alcohol products have already reached about 10% share in some European countries. Upgraded global growth forecasts for 2026 are supporting a more constructive outlook for cyclical sectors like materials and healthcare, with metals demand flagged as a key earnings driver. AI-linked industrial names underline the theme, from Siemens Energy's record gas turbine orders, which should translate into higher service revenues after 2028, to Generac's upbeat margin guidance and Micron's strong semiconductor demand. Still, the quality of growth remains uneven. Recent payroll reports showed job gains concentrated in areas such as healthcare, social assistance, and private education, raising concerns that the expansion is not yet broad-based across industries. Earlier in the week, we saw evidence of a K-shaped pattern, with AI-driven capex and top-tier consumption doing much of the heavy lifting, while youth unemployment and small business stress remain elevated in some segments. Structural forces, including AI making certain entry-level roles harder to access, could limit how far traditional job growth catches up, even if output and profits stay strong. For markets, this mix of strong but uneven growth helps explain the ongoing rotation away from mega-cap growth towards cyclicals, value, and selected small caps. The Russell 2000 has outperformed larger indices immediately after strong jobs prints and upgraded earnings expectation for materials, industrials, and some consumer names fit with a world where global growth in 2026 looks firmer. Key indicators to watch now are the breadth of future payroll gains, trends in manufacturing overtime and durable goods orders, and consumption data from emerging markets alongside European competitiveness reforms. Those growth signals are feeding directly into the policy debate, where the same payroll surprise has forced another rethink of the Federal Reserve's path. The January payroll surprise has materially reshaped near-term rate expectations. Headline non-farm payrolls around 130,000 versus a 65,000 estimate, combined with stronger private job growth and a lower unemployment rate, have reinforced the message of a resilient labor market. In response, U.S. Treasury yields rose sharply, with the 2-year moving higher by around 7 to 9 basis points, and the 10-year shifting from about 4.12 to 4.19%, reversing recent declines and pushing the first expected Fed rate cut from June out to July in many market pricing models. Fed messaging has leaned toward patience and data dependence, reinforcing that repricing. Several recent speakers, including new voting members, have signaled little urgency to cut while growth and productivity remains solid and unemployment low. Some forecasters argue that current economic data and company guidance do not justify expectations for multiple rate cuts this year, instead seeing room for perhaps 1 or 2 moves in the second half if inflation drifts from roughly 3% toward 2.5%. Capital Economics, for example, expects only a single cut, likely after a new Fed chair is appointed, and the incoming chair is described as wary of aggressive balance sheet expansion, which tilts the risk distribution toward a more cautious stance. At the same time, a more dovish camp remains active in markets. Interest rate swaps are still pricing scope for a third cut this year, and some participants point to softer elements within the labor market and subdued wage growth as justification for more easing. There are scenarios in which a fourth cut becomes plausible if inflation convincingly moderates, and periods of soft retail sales data or broader uncertainty have already seen parts of the market bring forward the possibility of an April cut before repricing back toward July on stronger data. In many frameworks, the unemployment rate remains the key variable. If it were to edge higher, expectations for 2 or more cuts could quickly reassert themselves. Global policy developments add another layer to the rate story. Chinese authorities are injecting sizable liquidity to combat deflation, but weak domestic demand raises the risk that some of that excess capital leaks into global asset markets rather than the real economy. In Japan, rising interest rates are triggering an unwind of long-standing carry trades, strengthening the yen and increasing cross-asset volatility as funding costs rise. Looking ahead, a cyclical weakening of the U.S. dollar is expected once U.S. cuts eventually materialize, which would support emerging market assets. But in the near term, delayed cuts have underpinned the dollar and weighed on assets, including Bitcoin, whose recent weakness some observers link to fading expectations of rapid monetary easing. Gold, by contrast, is increasingly framed as a universal hedge against fiscal risks, equity concentration, and policy uncertainty, with some bold forecasts pointing to significantly higher prices despite recent swings. Underlying all of this is the risk that traditional monetary tools are less effective against structural shocks such as AI-driven labor disruption. If job losses in certain segments are structural rather than cyclical, rate cuts may do little to restore those roles, while keeping policy too tight for too long risks pressuring more cyclical parts of the economy and markets. That tension raises the probability of a policy mistake in either direction and helps explain why volatility has risen even as growth data looks strong. Key watch points now include the next rounds of payroll and inflation data, Fed communication on balance sheet plans and leadership transition, shifts in Treasury yields around policy meetings, and price action in the dollar, yen, gold, and crypto. The policy path is more data-sensitive and contested than earlier in the year, keeping rate-sensitive assets, cross-border flows, and hedging strategies firmly in focus. To wrap up, the AI build-out is still powering infrastructure and energy demand, even as software, wealth managers, and alternative asset managers navigate harsher disruption pricing and wider valuation ranges. Growth data in the United States and globally point to a re-acceleration in goods output and selected consumer and emerging market segments. But the expansion remains capital-intensive and uneven across sectors and income groups. At the same time, the latest job surprise has delayed the expected start of Fed rate cuts, lifted yields, and widened the range of plausible policy paths, with global cross-currents from China and Japan and stronger interest in hedges such as gold. Putting this together, dispersion across sectors and asset classes is likely to remain high, rewarding close attention to business model resilience, rate sensitivity, and how quickly different industries adapt to AI. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.